welcome to the FII View. I'm Tanveer Gill in the Mumbai News Centre. My guest today on the show is Hugh, who's the head of global equities at Aberdeen Asset Management. Most of Aberdeen's Asia-dedicated funds have outperformed the category or the benchmark in terms of returns. And Hugh, of course, is a veteran fund manager. He's been in the business of managing money for more than 20 years. Hugh, it's great to have you on the show. Thanks very much for taking out the time to speak with us.
Thank you.
Right. At Aberdeen, what is the worldview that you're taking right now, given the fact that we've largely seen DMs outperform emerging markets for the year so far? Do you think that trade is likely to continue?
It certainly has been very sharply in favour of, for example, the US market, the US equity market this year vis-a-vis emerging markets. And if anything, I would say at a pure top-down level, one would start favouring emerging markets far more now, given the relative moves, and we're talking about quite a sharp 20-odd% relative move. Of course, the devil lies in the detail. In developed markets, you have many, many corporates earning their income from emerging markets. Less so the other way around, but you do have emerging market companies that earn their money from developed markets as well.
But do you think that the outperformance in US equities is likely to continue?
I think as a pure outperformance of US, no, I don't think it will continue. I think if you're looking at earnings generated and where earnings are generated from developing markets should exceed those generated from developed markets. The issue is that the corporates can be based in developed markets or indeed in developing markets. So there is a shades of grey between the two. So you can have a company in America earning a huge amount of money from the likes of India, Indonesia or Brazil.
Hugh, but talking specifically about the US, the two indicators in the US being monitored for recovery are really the labour market as well as the housing market. On both accounts, do you think the recovery is for real?
There's certainly evidence that the US is coming off the bottom, but it's evidence that indicates a very weak recovery, not a vibrant, strong recovery. And I think there's still some doubt as to whether the recovery is, or as to the reality of the recovery and how much of the recovery is a slight technical recovery. But yes, I would say the US is showing a lot better signs than the equivalents in Europe, for example.
Okay, talking about the US again, there has been a reclassification of the GDP calculation in the US to include research and development investments. What is the expectation now as far as growth is concerned in the US? The consensus still hovers around 2% for this year.
We're certainly not above consensus, so we're pretty cautious about US growth. So we'd be slightly under 2% for this year. And as you've just mentioned, you can do wonderful things with figures and reclassify things within figures. So I think growth of, say, 2%, if that's the figure, is nothing to get terribly excited about.
You know, amidst all the negative news and the nervousness on account of a potential QE tapering, the US equity markets have done really well. Of course, the dollar has outperformed as well, but the Dow is up 18%, the Nasdaq is up 19% plus. What is the rally reflecting, as there's much debate on valuations in US equities?
From a valuation perspective, US equities are not super expensive. Yes, they've had a very sharp rally. Part of that has been for the perceived or indeed real recovery in the economy. Part of it is due to technical reasons, such as shrinkage of the equity base within the US, share buybacks and the like. So there are a variety of reasons. And then, of course, we must always remember that markets can just run on emotion and knee-jerk reactions over short periods. And those short periods can be as long as a year.
There's going to be another event. There's going to be a change of guard at the Fed with the appointment of the new chairman. What is your expectation from that event, from a market sentiment standpoint?
There's certainly a lot of speculation as to who the candidate will be, or the victor, if you like, will be. And the market is torn between two different camps. I think everyone knows that at some stage you have to pull back on the easing policies. That's clear. But when will the US feel comfortable doing that and secure enough? We had a hint just a matter of weeks ago that it was time to pull in the reins a bit. You then saw markets get very jumpy, and immediately the Fed sort of retract on its earlier statement.
All right, in the wake of growth coming in the US and UK, where the estimates are being revised higher for 2013 and 2014, what will be the profile of investment in emerging markets? Will allocations reduce? Will they increase? What's your outlook there?
Well, certainly money has been coming out of emerging markets, and one is still seeing money coming out of emerging markets. Now, is that a belated reaction to quite sharp moves? I suspect to an extent it is. You often find markets fall or rise, and then people suddenly, if they've fallen 20%, people suddenly panic and sell, much the same as if they rise 20%, they panic and buy. So I think we might see a continuation of the sell emerging markets, buy development markets trend. But this is precisely when the brave, if you like, or the longer-term investors should be looking at emerging markets, because I think there's great confusion between the two, and there are plenty of companies in developed markets that have a large chunk of their earnings from emerging markets. So in many ways, you can be buying exactly the same stocks. You can be looking at the to take an extreme, the Unilever parent, which gets a vast chunk of its earnings from Hindustan Unilever, from Unilever Indonesia and the like. So I think in many ways there's a false distinction on the actual component parts of these markets that makes any big macro trend something, if you like, to bet against, providing you do your work on the detail and what actual companies you're buying underneath.
Yeah, exactly. Taking that point forward, do you think that investors should be looking at buying more of Hindustan Unilever, the stock, or the parent company, Unilever?
Well, it can be different chunks of money, or money can flow to both, of course. The parent enjoys strong earnings growth from many emerging markets. One of the stronger markets is India, so it's an important market. So it's slightly different specific examples. But then again, if you look at the relative valuations, the parent company, considering a large part of its business in Europe is fairly stagnant, is certainly far from cheap. It's also hard, I'm afraid, to argue that Hindustan Unilever is cheap either on the multiples it's on currently. So I'm not sure either is a raging buy at these levels. Both are good businesses.
You recently stated that value has dried up in Asia. Is it time to book profits then in Asia? Have you altered your Asia view over the last 6 months?
No, we haven't altered our view at all. We're still very comfortable with Asia. I think when one's looking at value within Asia, certainly over the next year or two, it's hard to argue there's great value, simply because there's not great earnings growth. So in aggregate for our Asian portfolios, we're talking about earnings growth of under 10% and a valuation of about 14 times earnings. And it's hard to argue that's tremendous value. There are some tremendous companies within that, and certainly for people with a horizon longer than the next 12 to 24 months, I think there's some great opportunities because these are companies that will prosper and will do better as economic growth picks up again.
In fact, just taking that point on earnings forward, do you believe there's more by way of earnings contraction in the region? Second half of this year was expected to be the period when we could see recovery in earnings and recovery in growth. How do you map the earnings cycle now, and when can we see definite signs of recovery or perhaps even stability in the growth slowdown that we're seeing right now?
Well, I think typically we find analysts or the street are always expecting a pickup in the next period, the next 6 months, the next 12 months. I think this year as a whole is going to be a fairly sluggish year, and our best estimates, or best guesses maybe, for 2014 are that that's going to be a relative sluggish year. Of course, it depends on what does happen in the US, how real and how strong the recovery is, less what happens in the likes of Japan. Europe is a big factor again in a global sense. And then in various countries we have domestic concerns. So I think for the next 18 months, the balance of this year and next year, we're being pretty cautious on the earnings front. We think the world is far from out of its troubles. Well, we all know the Fed at some stage has to reverse its policies, which means interest rates go up again. So there's some big question marks.
Yeah, but if we take that valuation parameter that you've laid out, 14 times average forward earnings for the region, then do you expect more downside coming into the market, at which point you will look to accumulate, or do you think that this is a good time to start buying into the market?
Well, we're relatively comfortable accumulating at current levels, 14 times earnings. We don't see earnings falling in aggregate. What we do see is earnings growth, the rate of earnings growth falling. So traditionally, throughout cycles, earnings in Asia have grown the best part of 15%, 15%. Now we're seeing, certainly over this period of a year, 2 years, 3 years, we're not sure how long it will be, earnings growth down at more like 7 or 8% growth. So that 14 multiple will, for example, come down to 13, to 12, and so on. It's quite reasonable, and should earnings growth pick up, again, back to the 15% level, buying today will prove to be a good investment, but it's only for investors, long-term investors with a decent time horizon, not for shorter-term speculators.
As a fund manager, are you getting sleepless nights managing the currency risk as it impacts your returns?
It doesn't give us sleepless nights. Certainly looking in aggregate at Asia, we expect Asian currencies over time to appreciate vis-a-vis, for example, the US dollar or the euro. We know on any given day or in any given year you can see some very sharp movements within that, and certain currencies have more worrying positions than other currencies within our region. But in aggregate, Asian currencies should continue, indeed, as they have done, to perform relatively well against other major currencies.
What's your view on the rupee then at this point?
Well, we're hoping that we might see, contrary to what people are expecting, a degree of strength coming through in the currency after the weakness we've seen. But again, notoriously, the rupee and rates have been difficult to predict. Well, India, as ever, is always a thorny subject and often suffers from self-inflicted wounds, and in part that explains what's gone on in India.
Let's discuss your India and China views, Hugh. You have been skeptical about China for a long time. How much of the EM view rests on the growth slowdown in China at this point?
Very little of our view on emerging markets depends on China. We are skeptical of China, as you rightly say, but particularly skeptical of the quality of Chinese companies. So that's been our big issue. We cannot find that quality of companies that makes us want to commit money to China.
What, in your opinion, Hugh, is impacting India more at this point in time? Local factors or global issues?
It's very hard to break up the India story. At the moment, India's suffering from a bit of both. It's suffering from the macro view that people are moving out of emerging markets or have moved out of emerging markets into developed markets. So that has affected India from a top-down point of view. And then from an India-specific point of view, the issues within India have also caused India to be relatively less attractive from that point of view. So it's a combination of the two as ever.
Hugh, there has been much concern about the growth slowdown in India and China, and there have been enough GDP downgrades coming in to that effect. Where do you see growth stabilizing for both regions?
Well, as far as growth is concerned, China this year will come in with its almost guaranteed 7.5%. Underneath that, you're looking at far weaker growth in reality. It's very hard to estimate what that growth is. I think one has to be suspicious of many governments' prognostications of growth and how they calculate growth, particularly areas like China. India, the growth is clearly slowing. How slow can it get? One can never tell. I mean, if governments and government actions are paralysed, and if one sees, as one has historically in India, a businessman saying, well, actually, to me it makes no sense investing in India. It makes far more sense investing in the US or wherever, because I can make forward-looking forecasts based on clear policies. That could be very bad news for India. We don't expect that. We're hoping politicians see sense, but you never know.
Okay, I just want to discuss a bit more about the areas that you find attractive at this point. How are you viewing banks in the region? There has been much pressure on the Chinese banking system. And even in India, just the bank index has fallen more than 18% year to date versus a rough 2% fall in the Nifty benchmark. Is it time to sell banks or buy banks, perhaps, as a contrarian purchase?
Again, they're banks and banks. I think within the region, one has to be careful. If you classify countries generically, we're particularly cautious of Chinese banks, which look very cheap on paper, single-digit earnings multiples and the like. But of course, how real those earnings are and what the loan book looks like, given the huge stimulation that China has had and how much of that has gone through the banking system, we do worry about. We have no exposure in our regional funds to direct to Chinese banks whatsoever. Conversely, if you look at India, we're a lot more comfortable with financial institutions. And our largest holding, I'd love to say it was cheap, but it's not cheap. Our largest holding is HDFC. We also have exposure to HDFC Bank and ICICI and some of the smaller institutions such as ING Vysya, with which we're fairly comfortable. Do we expect non-performing loans to increase as economic growth slows, or if economic growth slows? Yes, we do. We think, however, that the balance sheet of these banks and the lending practices are fairly robust, but undoubtedly bad loans will increase.
Right, but in the case that you're stating, if bad loans are to increase further, then I would assume that would put additional pressure on the stock prices of most of these banks. If that were true, then would you be looking at accumulating some of the names that you hold?
We're fine with the names we hold. Again, relative in portfolios, if everything falls together and we don't have new money coming in, we'll just stay where we are. If banks in isolation fall compared to other companies, we'll relatively put more money into banks. Now that can mean taking money out of whatever has held up or indeed gone up, and adding to our positions in the banking sector.
Okay, the other theme, of course, that's played out in the market quite remarkably has been the consumer theme. What's your stance there?
Yes, I would agree, and on balance we have been taking money piecemeal out of consumer names across the region. There's been a very clear sectoral split regionally, with consumer names performing extremely strongly, seeing multiples go up, in rare instances, up to around 50 times earnings, but in common instances, up into the high 20s, even the 30s in terms of prospective multiples. Now, they're great companies, but that's a high valuation.
Hugh, in this earnings season so far, all the large cap IT companies have delivered. Is it a sign of changing times, especially for companies like FII and Wipro, which have underperformed HCL Tech and TCS? Are you overweight Indian IT?
We don't hold any Wipro. We do hold for our sins Infosys, and we've held it for a long time, roughly the same weighting as TCS. We've decided to stick with Infosys. I mean, it looks on paper good value when compared to other parts of the sector. Yes, there are question marks, of course, over direction, leadership, and a slowdown, and we're hoping that will prove temporary. But it's a tough market, I think, for the IT sector as a whole, again, given what's going on in the world.
Hugh, is it also time to buy commodity stocks? In India, stocks like Hindalco, Tata Steel, Coal India have fallen considerably and are pretty much an oversold zone. Given your interest in Rio and BHP Billiton globally, is it time to look at these opportunities favorably?
Yes, technically those stocks are oversold. I think for us the worry again is more one of quality of the actual companies, some of the political issues behind the companies. So we don't feel quite as comfortable there, and we feel more comfortable with certainly in a regional context, with the broader brush of the BHPs and Rios.
Okay, what's your view on the rate cycle then? Do you expect rate hikes in the future in India?
I think rates could go up in India. There are certain things in India that one worries about, but then in a global context, we would expect rates to remain relatively low, but India's will continue to be higher than those rates elsewhere, given what's going on in the Indian economy. So could there be upward pressure on rates in India? The answer has to be yes.
Well, Hugh, thanks very much for joining us with your views on the market. Really appreciate your time today.
Many thanks. It's been a pleasure.
With that, we come to the end of this edition of the FII View. Thanks very much for watching the show.